And I do want to talk through more about how markets are responding to the latest data that we've received so far. And joining me now is Michele Schneider. She's the chief strategist at MarketGauge. Michele, it's great to see you this morning as always. And how should our viewers or investors be looking at the latest read on inflation?
Well, first of all, good morning, Kristen. Well, I think you have to go back a little bit and say that we've had 42 months now of consecutive CPI numbers over 3%. And now with the PPI numbers being a little bit hotter, what we can definitely conclude to date is that inflation has stopped going down. So, of course, the question is always going to be going forward, what can we expect? And let's keep sort of the politics side of it out of the equation right now because people are looking for actual real indicators. And that's where I always turn to the basic trifecta of what I call in terms of how we can gauge whether or not this is just a blip and policies will actually prove to be more deflationary or inflation is going to come screaming back. So number one is, we're looking at another reinversion of the bonds, right? And so basically what that could mean is economic growth. That would be obviously the cherry, or it could mean the return of inflation is on the way. So in terms of bonds, you've got to keep your eye there. You've got to keep your eye on the gold and the silver market, not only the pricing of the both, but whether silver starts to outtake gold, that's inflationary. You have to look at the dollar, which right now is not showing any signs of inflationary pressure. If anything, it's been incredibly strong. And you have to look at some of the soft commodities in the food. Particularly, I like to look at sugar. It hasn't really gone down very much. And if you look at the agriculturals in general, there are pockets that are still screaming much higher, while others are still very low. And how that all plays out, I think will give people a better indication of where inflation's going to go. And these CPI, PPI numbers, which many people feel are cooked, how representative they really are in terms of what the consumers expect.
Interesting. So we had seen for at least consumer prices yesterday, Michele, it was some of those costlier rents, for instance, that did send prices higher. We're heading into the holiday season. Now we have a new administration set to come into the Oval Office as of January 20th. I do see this morning, though, that traders are still pricing in another 1/4 percentage point rate cut come the Fed's next and final decision this year, which is in December. Based on the data, do you think that that is the right decision?
Well, it's a very big house of cards right now. And by the way, services has been the stickiest in terms of the inflation, and that's something to watch. In terms of the Fed, some people will scratch their heads and say, well, why would they lower when we have stock prices at all-time highs? And certainly if you look at it like that as a generalist, that could be a question. But if you go under the surface, not all stock of the stock market is at all-time highs. And this is where I like to look at the key sectors, which would be the small caps, the retail, and the transportation. And though they've done well, they're not at all-time highs. Transportation is. So the question is, what would he be doing to anticipate lower rates? And mostly it would be higher interest rates at this point could indeed affect the consumer and the job market. And I don't know if he's necessarily looking ahead at the Trump policies, but if he's looking at it right now, lowering it could help him have some confidence in terms of keeping the job market fresh, keeping the consumers in the game, and keeping borrowing costs from getting much higher as yields have been screaming up as opposed to down. And by the way, he speaks today, so there'll be a lot of ears listening on that.
That's right, Michele. 3 p.m. Eastern, I believe, is when the Fed chair is set to give those remarks, just an hour before the market closes. And we've seen, obviously, more data come in since we heard from the Fed last Thursday. What does a Trump administration and really a red sweep in D.C. mean for the markets?
Well, it is quite interesting. First of all, we obviously can see that America voted for major change and did not necessarily like what the Democrats were saying. And so, there's a consensus there, and it's basically from the economic standpoint. So there's a lot of optimism. In terms of what it means for the market, we can see actual results right now. that we can anticipate might or might not continue, of course, based on this inflation conversation we just had. But obviously, Bitcoin, I mean, that's been the big thing. So what is Trump going to get rid of capital gains tax on Bitcoin and cryptocurrencies? He said that today. So that could still be a big opportunity. If you're not into Bitcoin, then obviously you can look at some of the other altcoins. Ripple is one that we're very interested in. But also tariffs is going to be a big factor. And bringing everything back to the United States as much as possible. The question is going to be, can that actually be achieved without much higher costs for either A, raw materials, which would be inflationary, and if he can do it successfully with deportation and having enough people to fill the jobs, maybe more automation, it could be a really good year, especially if we calm things down geopolitically. So in essence, there's two aspects of the economy that drive besides the consumer. Obviously, interest rates would be one, but energy, and I think that's his biggest thing, is reducing energy costs, which could be a boon, but could also be, a curse in essence, because it could also gear towards recession. So there's a lot of stuff he's saying, but we don't really know how it's going to play out, which is why I go back to those indicators I said at the beginning. Watch the consumer, most importantly.
All right, Michele Schneider, Chief Market Strategist at MarketGauge.com. Michele's going to rejoin me after the market opens. Michele, thank you. Well, rejoining me now to break down what it means for you as a viewer and an investor is Michele Schneider. She's a Chief Strategist at MarketGauge.com. Michelle's great to have you back with me here. And of course, fractional gains at the open. Between our earlier segment and this market open, I was joined by JD Durkin, a political expert, to talk more about Trump's cabinet, how the building out of this cabinet might have an impact. Do you see a business impact at play here?
Well, one thing that I read today was that I hadn't really put together until I saw it is that his cabinet is very much millennial. So it is encouraging to see that we're getting a younger generation coming in to gain the experience in terms of being able to run the country, the government, the economy, and so on. So I think that's a positive. That's a real positive. So what does that mean in that if we do manage to achieve some of the objectives like cutting back on government spending, reducing the debt, and I'm not even going to go into the lofty calls that we have. Even any change would be a positive change there. If we start to look at things like expanding outside of the central bank and going more into digital currency, which we're seeing, all of this could be positive and a shift in the market. But it also could mean, again, we have to keep our eye on the inflation factor, because what we want more than anything is money to be in the consumer's pocket and not be afraid of inflation. And that's why that's going to continue to be my focus, regardless of who became president, but with Trump especially, because we know in terms of his populism, that's what he really wants. He wants America to be happy, and he'll do whatever he can to make that happen, I believe.
So, Michele, with yields rising in recent weeks, do you see opportunity in the bond market?
Well, as we mentioned in the first segment, the bond yields have been high, and in fact, they're actually delivering a higher return right now than stocks, which is very interesting, because if that's sustained, then we might see people pile more into a bond type of situation, a fixed income, rather than stocks. But I wouldn't worry about that, because it seems to me that the Fed will probably cut. And if that's the case, they're going to then reverse things where the long bonds could continue now to rise and the yields could continue to fall. So that could be the better opportunity. I just think it's a little too soon to say jump in and buy long bonds, or do the opposite of what a lot of people like Druckenmiller have done, short the long bonds, anticipating that will stay higher for longer because of the fear of inflation. This is a really interesting point right here, I think. So I would do nothing in terms of the bond market. I think we'll know soon enough if the TLTs start really catching a bid and the bottom is actually in at around 88, 89, and we can get back through 95, then I would start to think, yeah, there's your opportunity. And then, of course, what does that mean in terms of the trickling effect? Obviously, probably bullish for metals, energy, and other commodities.
So as this post-election rally, Michelle, has stalled, do you think what does that mean basically? I guess I'm wondering for investors. I mean, is it a natural consolidation phase or is it something else?
Well, right now, I don't see any real major risk happening right here at the moment. In fact, the stall, if it's more in the tech space, is probably healthier because what we want to see is money rotate into small caps, into retail, into transportation, into the banking sector, into the areas that are more US centric. And that's what we're seeing right now. So that has to continue. Let's look at XRT. That's my favorite. I call that the grandma of the US economy. If XRT, which was in a 10-month consolidation, actually continues to firm here at around $80 level and starts to shoot higher, I would say that the opportunity there is tremendous, particularly if you look at some of the things that have been undervalued in the retail space, not necessarily some of the consumer discretionary, but this notion of the thin trade that we've talked about, which is things that people will do to make themselves feel better as they start to lose weight from the diet drugs.
Yeah, I see XRT opening up about 0.7% higher here, Michelle, as you referenced earlier, for our viewers following along, of course, on their own programs. But Michele Schneider, we got to leave it there. Thank you so much. Great to see you as always. Michele's the chief strategist at MarketGauge.com.